It's a new month here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, surging bond yields. Short-term interest rates have been on the rise since the Fed began its path to higher rates back in March of 2022, but now longer-term interest rates are finally catching up, surging to their highest level in 16 years and threatening hopes for an economic soft landing. At the time of this recording, yields on the 10-year Treasury note had reached just above 4.8%, the highest level since the subprime mortgage crisis began in August 2007. Because government borrowing costs influence everything from mortgage rates for homeowners to loan rates for corporations, there's plenty of reason for angst. If the recent climb in borrowing costs, along with the accompanying slump in stock prices and the stronger dollar is sustained, that could meaningfully slow the U.S. and global economies over the next year. Looking ahead, traders are betting the Fed will cut rates to 4.7% in 2024 from the current range of 5.25 to 5.5%, and up from the 4.3% that they had anticipated in late August, indicating that rates may remain higher for longer. That's compounding worries about the fiscal outlook following August's Fitch U.S. rating downgrade and a potential government shutdown in November. Finally, the recent rise in long-term interest rates has begun to reduce the inversion in the yield curve. However, this typically has coincided with the onset of a recession. Number 2, earnings season. With the third quarter now in the rearview mirror, investor focus will shift towards earnings as companies begin to report their latest quarterly results. For the third quarter, S&P 500 earnings are expected to have declined 0.1% year over year. If 0.1% is the actual decline for the quarter, it will mark the 4th straight quarter of year-over-year earnings declines for the S&P 500. 8 of the 11 sectors are projected to report year-over-year earnings growth, led by the communication services and consumer discretionary sectors. The other 3 sectors are expected to post earnings declines, led by the energy and materials sectors. In terms of revenues, the S&P 500 is expected to report revenue growth of 1.6%, which, if achieved, will mark the 11th consecutive quarter of revenue growth for the index. 9 sectors are projected to report year-over-year growth in revenues, led by the consumer discretionary and real estate sectors. Again, the energy and materials sectors are expected to report the largest declines in revenues on a year-over-year basis. So what does this mean for stocks as a whole? Well, despite recent selling pressure, stocks have rallied in 2023 as the economy has proved more resilient than expected, and investors bet the Federal Reserve could soon conclude its aggressive campaign of raising interest rates, which crushed stocks in 2022. But while stocks have climbed, corporate profits have fallen, which now poses the question if investor optimism in the markets could soon evaporate if profits get squeezed further, calling into question the fundamental value of stocks. Number 3, the labor market. The first of 2 monthly employment reports was just released and could be pointing to a cooling in the labor market. The ADP private payroll report covering September showed that just 89,000 jobs were added in the month, down from an upwardly revised 180,000 jobs in August and below the 160,000 estimate from economists. At just 89,000, this marks the fewest jobs added since January 2021, when ADP reported that private employers actually shed jobs. In this month's report, ADP also said annual wage growth slowed to 5.9%, the 12th consecutive monthly decline. While the more widely followed employment report from the Bureau of Labor Statistics hasn't been released at the time of this recording, forecasts are for 150,000 jobs having been added in the month. The August BLS report showed that August employment rose by 187,000, slightly stronger than consensus expectations. However, the impact of revisions to prior months was significant and negative, with the June and July figures revised lower by a combined 110,000 jobs. With the revised data, job growth has now averaged just 150,000 jobs over the last 3 months, compared with a pre-revision average of 218,000 jobs. We continue to watch the latest employment data to gauge just how healthy the U.S. economy is. And that's been your Market Minute for the month of October. Thanks for listening.